Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, May the 27th, 2025, recording this in the morning, about 7:30 or so. Okay, so the main action overnight was basically in Japan. We can see here, just want to quickly look here at the chart. This is the daily chart for the 30-year yield, so the longer end of the curve. And as we can see here, this has fallen very, very significantly, gap down about 20 or 30 basis points or so. And one of the reasons for this, let's just have a quick look, is that there was a report coming out from Reuters. And just to go here over onto Bloomberg, this is the 15-minute chart. You can see here that the 30-year yield went from about 3.2% down to, what's that, about 2.9. So over like 30 basis points, so very, very fast and dramatic drop. So why was that? There was a report from Reuters basically saying that the Ministry of Finance had sort of given traders and banks and life insurers a kind of a questionnaire saying what was their view about the Japanese long end. And the implication here was that they were going to reduce the issuance, so reduce the issuance of the extreme long end, like especially the 40-year and the 30-year. And we know that in the last couple of weeks, there have been two very, very bad auctions for the 20-year and to a lesser extent to the 40-year. So the point here is that there's a lot of pressure on the life insurance companies over there. As the yields have gone up over the last sort of period, that means that the paper losses for the life insurers have gone down substantially into the billions and billions of, what I would say, dollars, but the hundreds of billions of yen. So there's a lot of internal sort of disquiet happening over in Japan at the long end. So all that to say that the long end sold off a lot. And just to put this into context, let's look at a couple of charts here. So we've got the Japanese sort of the curve here. So you can see here from the very front of the curve from the 1 month going out to the end. So it's very much in a sort of a regular kind of upward sloping curve. But if we look at, let's say, compared to 1 month ago, we'll just let this load up. Okay, so you can see here that all across the curve, the yields have gone up basically. But what you can sort of observe is that the yields have gone up the most on the long end here. You can see that the long end yields really are the ones which have gone up the most. So kind of interesting there. But what's also just want to point out here, if you look here at global 30-year bond yields, so we can see here all the different sort of, so you've got the US. Here you can see the German, you can see there's the Japanese one. Now, if you look at the Japanese one, the JGB here, you say, well, it's only kind of low, and you see here this recent fall off. So you go, well, what's the problem here? This is still only 3%. But what's actually more interesting is that if we normalize that, so I've normalized this to the beginning of the last 6 months or so. And what you can see here is that across the developed world, 30-year yields have gone up quite a lot everywhere. And this is on the back of sort of increased inflation fears, increased fears about the tariffs being inflationary and supply chains being less efficient, and also government largesse. So basically this idea that governments are sort of fiscally not being very disciplined, and also issuance. So all of this is pushing up long end yields. But what's interesting, if you normalize it, let's say back to 6 months, you can see here, this is the US in the white, which, has had a little bit of a gain. Then you look at the German, which has gone up quite a lot. But look at actually the Japanese here. So the Japanese is this sort of apricot peach color. And you can see here that this is the one which, from a starting point of around about sort of on a level of 100 was up to 140. So that's the one on this normalized chart here, which has gone up the most. So a lot of pressure on the back end in Japan, and also a very speedy move. And we know that from research that what equity markets, for example, don't like, it's first of all the long end yields going up. They don't like that in general, but it's the speed at which they change. If long end yields rise too quickly, that puts equity markets under a lot of pressure. So that's all causing a lot of concern. So what's been the reaction to all of this overnight? So first of all, what we've seen is that as those yields came down on that announcement that the Bank of Japan and the Ministry of Finance might actually sort of stop issuing so many bonds. So that's obviously a positive for the yields. So the yields have come down here. We've seen that all across the board. Let's first of all look at all the bonds. We can see that, for example, the ZB in the US, that's had a pretty nice push upwards. We can see that the Ultra bond in the US has had a nice push upwards. And if you want to compare that, look at, let's say, the front end of the curve, which has hardly moved. So this is pretty good news for anything from, let's say, like the 10-year out. And if we look in Germany, we'll see a similar kind of situation here. We can look at the Bund here, which has had a bit of a push upwards. But also, if you look at the books, also the 30-year Bund, the 30-year Bund, that's also pushing up. So that looks as though it wants to go a little bit higher. But also look at something like over in Italy, that also pushed a little bit higher as well. So basically pretty good for the 30-year. And then if we look at the curves here, we can look again. I don't have the Japanese yield curve just up here, but I'm just curious to see whether in the US, for example, we let's have a look at the German. Actually, there's a German. So the 230s in Germany, you see how that's flattened. So basically, we've had the long end yield, the long end yields coming down as the prices have gone up. So we've had a long end led bull flattener in the German curve. And if we look over in the US, I suspect it's going to be the same kind of thing as well. Yeah, so we're having a bull flattening. So this is all pretty positive also for the equity market. But in terms of the currency markets, this is obviously this sort of collapse in yields. That's put a lot of downward pressure on the Japanese yen, at least in the short term. So if we actually look at the Japanese yen here, which we will see shortly, where I okay, so you can see here that the USD versus Japanese yen up 88 basis points, which is so. Let's have a look here. So you see the nice big green candle here. What's going to be interesting is that at the same time, or actually a little bit earlier, before this sort of news article came out, which pushed down the yields, is that we had the governor of the Bank of Japan, Ueda, who essentially came out in a speech and said that he would be raising rates, or the Bank of Japan is still on course to adjust monetary policy to raise rates if the economy sort of improved and performed as expected. So initially, that gave sort of a boost to the yields and a boost to the Japanese yen, which has subsequently been turned down. So really what we're going to see now is a bit of a tug and war here, that we sort of have apparently sort of structural weakness in the US dollar. We have potentially a Bank of Japan, which is going to be hiking, but we have downward pressure potentially on the long end of the curve in Japan. So that could be like an equilibrium. So two forces are fighting each other. But at least for today, a bit of reversal. And it is true that the Japanese yen had actually been strengthening here, or the USD JPY weakening, as you see here on the chart, for the last 6 or 7 days. So a little bit of a pullback here. So this is going to be interesting here to see if this marks a local low, or whether this will just be faded, after a day or two. Let's see what happens here. But just in the meantime, today we do have some dollar strength. So if we look at the dollar index, which of course is about 58% euro, we can see that the dollar is pulling itself up. It's still underneath the key 100 level. Also, in terms of the, excuse me, actually, I have some tea. Excuse me. In terms of this Fibonacci, which we highlighted yesterday, so the 99.5 more or less, it's still below that. So the bulls still have a lot of work to do. And what's kind of interesting, at least for me, is just to look at the reaction. So the US dollar had a bit of strength, but only up 23 basis points against CAD, against the Aussie up 56 basis points, against the Chinese renminbi only up 25 basis points. And against the euro, only up 29 basis points. So the reality is that a lot of this, seeming sort of dollar strength has actually been translated through the medium of the yen weakness. So let's see if that continues. And certainly, if the yen were to strengthen up to to weaken up to 146-ish, something like that, I think we would get some dollar bears coming in and hitting that as well. So that's a pretty big issue. Now, just as we've had all those yields being pulled down, we're seeing volatility down again, and to be honest, like a very nice push up here on the equities. They came off this Fibonacci level, which we can just quickly throw on here on the chart as we're looking at it. So you can see here that they came down from the most recent impulse starting on about the 7th of May. We can see that the Fibonacci at the 61% level, which is about 57.50 odd, that basically held after Trump sort of held off on the reverse course on the European tariff imposition. And what we've been seeing in the last 24 hours or so, obviously yesterday was a holiday in the US, is that the Europeans are basically saying, yes, we're working hard on sectors which can work, which we can work towards an agreement with the US. So at the moment, the equity is enjoying those lower yields and a little bit of risk on positivity. So it looks as though the ES, definitely from a technical perspective, again, throwing on a few just basic moving averages here, above all its moving averages, bounced off the fib, a little bit of risk on and sort of significantly lower sort of long-term yields today at least. It looks to me as though the ES probably the next point is going to be upwards about 59.90 or so. That looks like a sort of a short-term target. NASDAQ actually doing even better, up 1.5% on the futures, and it looks as though that's going to push up to 21,000, about 600 or so. Keep in mind, we do have NVIDIA tomorrow, so that will no doubt sort of cause sentiment to sort of become more positive or a little bit more negative, especially on their forward guidance. But we can look at that tomorrow. But in the meantime, we've got the equities up. We also have the European equities up. If we have a quick look over at global equity here, we can have a look at, let's say, the DAX, the German, pushing up to new highs. So as those bond yields are going down, basically, this is blue sky ahead. That's looking like it's going to continue to push up. So anyone in a long trend following, sort of who's long the German or European futures, that looks like a positive thing to stay in at the moment. So that's that. Other issues we've got today, just getting back to the bonds, we do have a 2-year auction. So let's just look at the 2-year yield. The 2-year probably should have relatively good demand. It's been having relatively good demand over the last few auctions. We have the 5 tomorrow and then the 7. They might be a little bit more problematic. But as I pointed out yesterday, as long as the Fed is not going to be hiking rates, we've got a Fed funds rate at the moment, effective Fed funds rate at about 4.33. So it's possible that the 2-year yield, on strong economic data, on inflation remaining a little bit sticky, on Fed members like Kashkari overnight in Tokyo, basically saying he wanted to be patient, and didn't want to do anything until they had more data. For sure, the 2-year yield could climb a little bit. I would say, maybe up even to test this 200-day moving average at 4.110. But I think anything above that is probably going to be, as I think I said yesterday, interesting to think about good risk reward for maybe call spreads or something like that, because anything too much higher there we're starting to get into the territory of saying that the Fed, will not sort of cut at all in the next 18 or 24 months, which I think is relatively low probability. So let's look at the auction today, although probably the main action is going to be in the 5s and the 7. Just in terms of a couple of other things, we did have overnight in France lower than expected inflation numbers. Again, that's going to give the ECB a little bit more confidence to potentially continue their cutting cycle. We have the ECB June meeting coming up. I think it's next week. I'll have to check the date of that, but they are scheduled to keep on cutting a couple of times. So we'll see what they do. But if we just look at the bonds here, the OATs, which I have here, you can see that they actually popped on that sort of lower than expected inflation, and also with the lower yields over in Japan, but they've subsequently given that back a little bit. Interesting to keep an eye on the OATs here, the French 10-year, just because they are approaching a little bit of resistance at 125 here on the futures. And the question here is that their fiscal house is not in order. So structurally, France is under pressure. Also, their president's being slapped by his wife in public, which is probably not good for investor confidence, possibly. That's a joke. So we'll see what happens here with the OATs, but they could be under pressure. And we see here actually that the spread, that's indicated by, if you look at the spread here between Italy and France, you can see that that's actually very, very low on a historical basis, now down to about 33 basis points in favor of Italy. But if you look at this, just going back here on this chart, you can see that, historically, so to speak, going back, the last 4, 5, 6 years, this has been up to 100, 200, even up to 300 basis points. So the point here, well, let's say 250 basis points or so. So the point here is that investors, investing community are quite enjoying the extra yield pickup which they get in Italy. It's perceived to be relatively stable at the moment, as we saw last Friday. Moody's had a little sort of upgrade for Italy. So Italy doing quite well in terms of investor sentiment at the moment, and this spread between Italy and France continues to go further down to close, getting down towards the 0 point, which would be symbolically quite a big thing because it hasn't been there. I'm just curious if we go back on a weekly chart, we haven't been down to zero. We'd have to go all the way back, like even to 20 years. So you see where we are here, just historically on a weekly chart going back, 25 years, that we're at extremely low levels. It can go a little lower, it can go to parity, but this is a big vote of confidence in the Italian situation, which is curious because although Meloni's government has been fiscally quite responsible, the reality is that Italy's debt to GDP ratio is still enormous, one of the highest in the developed worlds. And so it seems to be that the ECB behind the scenes through the various programs is actually reinvesting German bonds as they're rolling off and putting them into Italian bonds and Spanish bonds. So there's definitely redistribution happening within the European community to the benefit of the peripheral nations, so-called peripheral nations, which is improving these spreads. So I think that's political at the moment. I wonder if there was not such a political intervention by the ECB, whether these spreads of, let's say, Italy, Germany, and Italy, France would actually go out a little bit more. In terms of other stuff, just have a look at the oil. Not a huge amount happening in oil, just stuck in a little bit of a range here. Oil at the moment is stuck between two narratives. We have an OPEC Plus meeting coming up this weekend. I think it's the 30th, the 29th, and the 30th of May. There's already been sort of rumors that they being OPEC Plus will increase their output by another 411,000 barrels a day, and that's the number which they increased over the last meeting. So that's a bit of a negative, at least negative for sentiment. There's some talk that demand in India is going down or is not sort of expanding at the sort of necessary rate. On the other hand, on the positive side, you have a potential sort of a de-escalation of tensions in the trade and tariff wars between Europe and the US. So that's maybe a positive for global demand. So oil at the moment is a little bit confused, just sort of sticking here around about the 20-day moving average, finding it hard to push up. Those moving averages are still pushing down, and it's finding it hard to even break out of Fibonacci zone. So I think at the moment that's a little bit of dead money. We'll see what OPEC Plus has to say. Just finally, guys, want to have a quick look here at the data. We do have some data today. We have durable goods, which is for the April period. Let me just bring that up. So you can see we have durable goods at 8:30. That's expected actually to be compared to last time. You see last time plus 9.2, minus 7.8. And then the one which is probably most important is capital goods orders, excluding aircraft. These two here. So they're expected to be a little negative. But durable goods, to be honest, is quite a volatile number. There's often a lot of revisions, so keep the eyes on revisions. But what is going to be interesting is that this goes back to the original kind of Liberation Day, 2nd of April. So this is for the April period. So I don't know if this is old news. If this is positive, will people say, oh, it's just people sort of front running and buying stuff before the tariffs came in, or if this is negative, will the narrative and the conclusion be that, oh, a lot's changed since then, so it's sort of old news. I don't know how much importance this is going to be for the market. We could get a few squiggles and wiggles for a few minutes, but I don't know that's super important. The other thing which we do have at 10 o'clock as well is the consumer confidence from the conference board. Again, this is for May period, so in theory, this could be reflecting some of the impact of tariffs or the narrative surrounding tariffs. But increasingly, these confidence surveys, they do seem to be very partisan. They do seem to be very much sort of Republicans tend to be more positive, and people leaning Democrat seem to lean a little bit more negative. So they're becoming a little less interesting in terms of what they're actually telling us about the broader situation in terms of US consumer confidence. Having said that, let's keep an eye on it and look at for that. So that's about it. We have Williams. I think he's over in Tokyo. So Williams of the New York Fed, head of the New York Fed, always very important because he seems to have the ear of Jerome Powell. What I have seen over the last week from Fed speakers is, I would say, kind of caution. There aren't too many doves out there saying, beating the table, pounding the table, saying that, the Fed needs to sort of get ahead of, a potential economic slowdown and cut if, and no one's saying they should hike. So really the mantra seems to be neutrality data dependent. But in my humble opinion, we could have, many, many weeks, if not several months before we have more clarity on the tariff situation. So I just wonder, whether the Fed, at what point they need to actually be a little bit more proactive. That's going to be that's probably the main debate at the moment, which will have to be resolved. Okay, I'll leave it there, guys. Have a great day. Let's keep the conversation going and enjoy yourself. Thank you.